Hey, listeners, are you ready to take control of your car buying experience and make smart financial decisions? Introducing the Ultimate Auto Finance Guide, your go to resource for navigating the complex world of auto finance. Whether you're a first time buyer or looking to refinance, this guide has all the tips, tricks, and insider knowledge you need to secure the best deal. Don't miss out on this opportunity to empower yourself and drive away with confidence. Head over to www.ultimateautofinanceguide.com now and grab your digital copy. Trust me, it's the smartest investment you'll make before buying your next car. Welcome back to another episode of Drive to Success Mastering Auto Finance, the podcast that brings you insights into navigating the world of auto finance and helping consumers make informed decisions in the ever-changing automotive industry. I'm John Lewis, and today we're going to explore an important topic that every potential car buyer and auto finance professional needs to understand: the true cost of vehicle ownership and how vehicle valuation, depreciation, and financing are all connected. Whether you're buying your car for the first time or whether you're in the market to trade up, this episode will help you make smarter decisions when it comes to financing. Let's start with vehicle valuation. Every vehicle on the market has a specific value at a given time, which is determined by several factors. These include the car's make, model, age, mileage, and overall condition. Whether you're buying a new or used car, it's important to understand that its value will change from the moment you drive off the lot. But what causes a car's value to decline over time? This is where depreciation comes into play. Depreciation is the gradual reduction of a car's value over time. On average, a new car loses about 20 to 30% of its value within the first year of ownership. By the end of 3 years, the car could lose up to 50% of the original value. This means a $50,000 car might only be worth $25,000 after 3 years. Depreciation is a natural part of owning a vehicle, but it's important to factor it into your financial decision-making process. Now, let's dive deeper into depreciation and why it matters. As I mentioned, depreciation is the loss of a car's value over time. But what causes it to happen so quickly? There are 4 key factors that influence how fast a vehicle depreciates. Number 1, mileage. The more you drive, the faster the car wears out and the less it's worth. High mileage cars tend to lose value quickly. 2, condition. If the car has been in an accident or hasn't been maintained properly, its value will drop faster than the one that's in pristine condition. 3, brand reputation. Some brands hold their value better than others. Luxury brands or vehicles with strong reputations for reliability tend to depreciate more slowly. On the other hand, cars with a reputation for costly repairs or recalls can see their value plummet. And finally, market demand. Trends also play a role. For example, SUVs and trucks are in high demand today, and so they tend to hold their value better. But if demand shifts in a few years, their depreciation rates could increase. The most important thing to understand about depreciation is that it's a hidden cost of owning a vehicle. It's not something you pay up front, like a down payment or registration fee, but it's something you should always factor into your overall budget. All right, now that we've covered vehicle valuation and depreciation, let's talk about how this affects your auto loan. One of the key concepts to understand when financing a vehicle is the loan-to-value ratio, or LTV. This ratio compares the amount of money you're borrowing to the actual value of the car. Let's break it down with an example. Say you're looking at a car valued at $50,000 and you want to take out a loan for $45,000. The loan to value ratio will be 90%, meaning you're borrowing 90% of the car's value. Lenders like to keep this ratio below 100% because it reduces their risk. If you borrow more than the car is worth, the lender's in a vulnerable position if something goes wrong, like a default or total loss accident. But here's the kicker. Depreciation can quickly turn your LTV upside down because cars lose value fast, particularly in the first few years. It's possible to owe more than the car is worth. This is known as negative equity or being upside down on your loan. In this scenario, you might find yourself in a difficult financial situation if you need to sell or trade the car before the loan is paid off. To avoid negative equity, there are a couple of things you can do. One, make a larger down payment. This lowers the amount you need to finance and keeps your loan to value ratio in check. Two, choose a car with a strong resale value, meaning it holds its value better over time. Be cautious about long loan terms because they spread out your payments, but increase the risk of being upside down if the car depreciates too quickly. Now, let's talk about how vehicle valuation and depreciation influence your loan terms. The first thing to consider are interest rates. Lenders base these rates on the risk they're taking when they finance a vehicle. Cars that depreciate quickly are riskier investments for lenders because if the borrower defaults, the car might not be worth enough to cover the remaining balance of the loan. As a result, cars that are known to hold their value will tend to qualify for lower interest rates, while cars that lose value quickly may come with higher interest rates. Next, there's the length of the loan. Typical loan terms range from 36 to 72 months, though longer loan terms are becoming more common. The longer the loan, the more interest you'll pay over time, but the lower your monthly payments will be. It's tempting to opt for a longer loan term, but keep in mind that spreading the payments over the next 6, 7, or even 8 years means that the car will have lost significant value by the time you've paid it off. This can be problematic if you want to sell or trade in the car before the loan is paid off. Lenders may push for shorter loan terms on vehicles that are expected to depreciate quickly to ensure the loan balance is paid down while the car still holds some value. To sum it up, the interest rate and loan term you get will depend on how the vehicle holds its value over time. A high depreciation car may come with a shorter loan term and a higher interest rate, while a car that holds its value will give you more favorable loan terms. Make sure you understand how depreciation affects your loan options before signing on the dotted line. So far, we've covered how vehicle valuation, depreciation, and loan to value impact your auto loan. But how do all of these factors come together to shape the total cost of vehicle ownership? Let's not forget that owning a car involves more than just loan payments. In addition to depreciation, you need to factor in costs like insurance, fuel, maintenance, and repairs. The more a car depreciates, the more expensive it becomes to insure. Cars that require frequent repairs or use lots of gas can also become a financial burden over time. This is why it's essential to think beyond the initial purchase price or monthly payment and consider the car's long-term costs. To manage these costs effectively, follow these tips. Research resale values before buying. Cars with strong resale values will save you money in the long run by depreciating less. Next, plan for higher costs beyond the loan. Fuel, insurance, and repairs add up, so make sure they fit into your budget. Finally, make a down payment of at least 20%. This will reduce the loan balance and protect you from negative equity as the car depreciates. Understanding how vehicle valuation and depreciation affect your financing options and overall ownership costs will help you make smarter decisions. The goal is to minimize unnecessary costs and avoid financial pitfalls like negative equity. When you're armed with the right knowledge, you can confidently drive your way to success. Thanks for joining me on this episode of Drive to Success Mastering Auto Finance. I hope this deeper dive into vehicle valuation, depreciation, and financing gives you the tools you need to make informed decisions. Don't forget to share this episode with anyone who's in the market for a car or looking for a better understanding of their auto loan.
Rolling down the avenue to a jazzy beat, following that rhythm, life's a one-way street. Chasing dreams with passion, every mile's a goal. In the world of finance, stories to be told. Catching the horizon with a soulful groove. Navigating numbers, got nothing to lose. Every calculation, every deal we sway. In the realm of autos, we find our way. Drive to success, we're mastering the art. Through the lanes of finance, we set apart. Jazz and soul, where the numbers align. Make your journey smooth with wisdom divine. Hit the keys of knowledge, let the insight play. From leases to purchases, every savvy way. Revving up those engines, zeros turn to ones. In the studio of life like morning sun. Feel the soul, embrace the jazz. In the auto world, let's razzmatazz. Financial gears shifting smooth and slick. In the podcast lane, we find the tricks. Cruising through the jargon, ain't no mystery. Unlocking all the secrets in auto history. Low ones and rates, they glisten like the stars. Drive the distance, no matter how far.
Thanks for sticking around until the end. Before we go, if you're in the market for a new or used car or even thinking about it, you must check out Drive to Success, the ultimate auto finance guide. It's packed with strategies to help you navigate the tricky world of auto financing, avoid costly mistakes, and get the best deal possible. Head over to Amazon and grab your copy today. Just search for Drive to Success, the ultimate auto finance guide, or use the link in our show notes. Take control of your car buying experience and drive away with confidence.